Thanks very much. Good afternoon, everybody, or good morning, good evening for those watching online. The final session of the conference is going to be looking at geopolitical issues, how they affect investment into Africa, different relationships going forward for the continent. It's been a complex area for many years, and I think it's even more recently been made more complicated by the pandemic, the consequences of Brexit, inconsistent US policy on investment, and obviously the very most recent events over in Eastern Europe. So I think it's interesting to note that the Forum on China-Africa Relations has said that since 2018, infrastructure and projects has dropped by something like 90%, and capacity building education has dropped by 80%. And one of the areas we're going to be looking at is the reason for that and who's going to be able to take advantage of that situation. So if I could invite the panel to come up to the stage. Okay, so we're all ready to go. So perhaps if I could start by getting the panelists to give a brief introduction of themselves. Monale, if I could start with you.
My name is Monale Ratsoma. I'm the Director General for the New Development Bank. Some know us as the BRICS Bank. Our focus is on financing large infrastructure.
Good afternoon, everyone. My name is Sekete Mokgehle. I am the head of export credit finance at Nedbank CIB. We finance infrastructure, or we find risk mitigation solutions to debt finance. And primarily our lending goes to financing the sovereigns on the African continent with their infrastructure needs.
Good afternoon, everyone. I'm Jim Murphy. I'm the Managing Director of Arden Strategies. My background is in politics, initially in the UK, where I was a cabinet minister in Tony Blair's government. I'm responsible for pandemic planning and technology and things that we would never need. And Minister of the Foreign Office responsible for global diplomacy on behalf of the UK. I now run our firm. We help people win elections internationally, and we also help build relationships between CEOs and governments across the world. Thank you.
Good afternoon, everyone. Can you hear me? Yeah, perfect. My name is Robert Besseling. I'm the CEO of Pangea-Risk. We provide analysis and forecasts on political, economic, and security risk in both Africa and the Middle East.
Thanks, Robert. Okay, so to start off with, I'd like to come to you, Jim, to get your views on the landscape as you see it at the moment from a geopolitical level to set the scene, as it were.
Thank you. And to sort of give a sense of context, I just thought I'd reflect on where I think we are at the moment and what we are seeing. And so this is a different reflection than would otherwise have been the case a month ago. But what's happened in the last 2 weeks with Russia's invasion of Ukraine is one of the four most important events in my life. First, of course, the collapse of the Berlin Wall. Secondly, 9/11. Third, COVID pandemic. And fourth, Russia's invasion of Ukraine. And some may think that's an overstatement, but this will cause long-term geopolitical contest and realignment that certainly people of my age in the audience will be living with the consequence of for the rest of their professional life. If you're British and in the audience, of course, there was a fifth event, that mistake called Brexit. But in terms of the specifics, how would I summarize things? Russia, weakened, wounded, isolated, but dangerous as a consequence of each of those circumstances. China, I would describe, if I was looking for one word, frustrated, because we're in a situation, of course, where China and Russia are back-to-back neighbours, both traditionally, recently anyway, looking outwards. And they both want different things from the international architecture that governs the world. China, with a trajectory as it is, benefits from the current architecture of global governance because it's a trajectory that takes them to continued success. Russia wants to drag down the rules-based international order. So there's a sense of frustration. And actually, there's a sense of anger in Beijing that Putin has upset the planning of the 20th Communist Party Congress later in the year. President Xi wanted no risks in advance of that event, and the invasion of Ukraine creates a risk that the Chinese Communist Party certainly didn't want. So having spoken about Russia, China, how would I summarize the West? United, but uncertain. It'll come out of this period with increased defence spending, increased ambition. The European Union has been reawakened after the knock to its confidence caused by Brexit. And the European Union will be much more ambitious as a consequence of what's happening. And then the last thing to just mention, and we can talk about these for the rest of the session if we had more time, some of the impacts on Africa. Well, first of all, I grew up in South Africa. I know I don't sound like it. Right? I grew up in this city. And it's not immediately clear to me as someone who follows politics every minute of every day where South Africa thinks it fits in to this changing global architecture. It's not clear. But nevertheless, the impacts are clear. Upward pressures on prices, food, meat, and other produce that the population rely on. Less tolerance of African migration to Europe as a consequence of a continent feeling increasingly full as it takes in many millions of Ukrainians. There is opportunity, of course, because there's going to be a displacement of economic activity out of Russia. That investment needs to find new homes, and there's reasons why some of that could be in Sub-Saharan Africa. And then the final point, where I think leaders across the continent, including some that we advise, have still to work out, is how do governments fit into what is now a Western double pivot? It's a well-rehearsed argument about the Pacific pivot launched by Obama and supported by Germany and the UK. But now we're going to have an Eastern European pivot as well. And leaders in this continent, business and political leaders, are going to have to work very hard not to be squeezed out of investor and government attention in those European capitals, in the US, Japan, and in other capitals across the world. That's how I see it. I might, of course, be entirely wrong, but those are my reflections.
Just picking up on one of the points there, you talked about China. One of the things that's interesting to me is that the whole China-Taiwan issue as well. Do you think what has happened recently in Russia and the West's or the rest of the world's response to it will have altered China's views or ambitions in that respect?
Pre-COVID, I spent quite a lot of time in Taiwan for these very reasons. We have lots of clients there. My assessment would have been prior to, well, what did President Xi wanted this year? He wanted to reinforce his control of Hong Kong, wanted to maintain his zero COVID policy in his cities, and he wanted to prepare for the Party Congress. I haven't believed, since I've got to know Taiwan a good deal better, I don't think it's in China's near-term ambition to militarily take Taiwan. And I think one of the sources of frustration in Beijing will be how united the West has been. I mean, when Russia only has Belarus, North Korea, Syria, and Eritrea, plus 34 abstainers, including South Africa, in his column, that's a real worry for military, economic, and diplomatic planners in Beijing. And they've been taken aback by the scale of the response. Now, one thing that we can't yet factor is to what extent the world would act in a very similar way. But what we should prepare for is that the geopolitical competition that President Trump spoke with real passion, not so much accuracy, but real passion, we're going to see that in the US-Russia relationship in a way that we haven't seen since the late 1980s. For Russia, the hope will be, of course, that President Trump, I mean, Putin's calculation is partly that he survives long enough for President Trump to be re-elected. And there's a race against time in Europe to change the circumstances on the ground so that if Trump is re-elected, he cannot shatter the coalition that has been built up over the last few weeks. So I think short answer to your question is China will be looking with great interest at the international response on Ukraine and will be increasingly worried about the strength of that in light of their Taiwan ambitions. But I would see a military ambition for Russia, for China and Taiwan in a sort of 20, 25-year time slot rather than the tomorrow.
Thanks. So to bring this back to an Africa context, Rob, if I could come to you next to look particularly at the China relationship, but generally in terms of investors and potential investors. How do you see the relationship at the moment between China and the various countries on the continent? Is there a pattern there in the way that they're approaching it? We're going to come on a little bit later to the specifics around the types of investment they might make, but just as a general trend pattern.
Thank you, Simon. When we planned this session, this was going to be the China in Africa session. And of course, current events have taken over. And I'm really glad that Jim has already laid the background, the context, and global geopolitical level, because there's so much else to factor in. There's Russia and Ukraine, there's Taiwan, and all of this relates back to the topic of our conversation today. And that is indeed China in Africa and how that relationship is changing. It was changing already before the 24th of February when Russia invaded Ukraine. China looks at Africa based on 3-year plans. Like they always build long-term plans. China has its own economy developed around long-term plans. Its relationship with Africa is the same. And previously, it was always based on $60 billion for every 3 years, infrastructure in exchange for debt. And that has created the largest trading relationship, apart from the European Union, $200 billion worth of trade between Africa and China at the moment. And that is now set to go to $300 billion over the next 2 to 3 years. The relationship is changing because we're no longer talking about $60 billion for the coming 3 years. We're not talking about infrastructure for debt either. Now we're talking about $40 billion, most of which is trade finance. And most of that is going not directly to African sovereigns, but it is going to international financial institutions, some of whom are here. So the relationship is changing. It's a huge boost for trade finance. African governments have been complaining for a long time that the trade gap is too big, that it's too focused on taking oil and gas and metals out and not other exports, like manufactured goods, for example, or textiles. So the relationship is changing, and China is actively trying to shape it towards a more fair, equitable relationship. And that's been the rhetoric, the narrative over the past few conferences between African governments and China. And it's also now what the Chinese government has committed to. It will be interesting to see how, going back to Jim's points here, how the changing geopolitical sphere will actually potentially waylay these plans, because there will be opportunities for China to step in. But maybe just a final point, Russia's trade on the African continent is just $20 billion. And that was before the 24th of February. China's is $200 billion and growing to $300 billion. So the opportunity is there, but I can't say it's going to be a huge one. Simon.
And do you subscribe to the view that part of the reason why China is perhaps looking away from these big debts, I'm thinking of the ports in Mombasa, the huge Zambia debt, Entebbe, that sort of thing, because of the perception of what they are being blamed for,
rather than it necessarily
rather than it necessarily being something that they would otherwise have done?
Total value of Chinese debt held in Africa is $153 billion of disbursed loans. The loans, I think, is just over 1,140 loans. A third of that is to Angola only. And then the next big ones are Ethiopia, Zambia, and Kenya. All four have recently been rated as being at risk of debt distress or actually in debt distress. Zambia defaulted in 2020. Ethiopia is going through the common framework process. That's stalled at the moment. Kenya, there's lots of concerns about Kenyan debt. And of course, Angola, even though we've seen some real improvements in its currency and its rating outlook more recently, there is still a huge amount of debt that needs to be revised, restructured. The answer to your question, I think it is, one, China does not want the debt trap narrative to focus on its reputation, but also it's a repayment problem. China does not want to deal with borrowers anymore who can't repay. They've had problems in Kenya, they've had problems in Ethiopia, and in Zambia, of course, as well. There have been late payments or complete restructuring. So there's one of the reasons why we're seeing less Chinese infrastructure for debt is not just reputational risk for China, but also it's about actual concern about repayment.
Thanks, Rolf. And Sekete, if I can come to you now, again, on the China side, we are seeing this move away from the infrastructure to the trade finance side. Do you think it's the right time for Africa for this to happen?
Maybe before I answer your question directly, just to touch on one or 2 points that my colleague Robert just mentioned, and hone in on the importance of China to Africa, particularly in the past 2 decades. China has played a very critical role in assisting Africa in terms of what I would call it offering alternative sources of financing. And a lot of money went to sovereigns that may not have had access to the traditional methods of financing. And I'm glad Robert just picked up on data that over that past 2 decades, there's been $153 billion worth of debt that China wrote for the African continent. That's significant by any means. And the figures are corroborated by, if you look at the export credit finance, which of course I am from that space, and look at the league tables as far as the ECAs are concerned, you would see the likes of Sinosure, China Exim, taking number 1 and 3 positions over a 5-year period, again signifying the importance that China has always been. But to come back to your direct question, the Africa-China Forum talked about the move from capital financing to trade. Is it the right time? No. In my opinion, it's not the right time. And I'll say the following. One, we are aware Africa has got this huge infrastructure deficit. We are aware that Africa needs infrastructure badly, particularly if it has to achieve its aspiration of inter-Africa trade. But you would argue, does China care about Africa's problems? Maybe their investments over the past period was to serve their interest, and therefore there is really no benefit there necessarily for China to be wanting to continue serving its old costs. And the point Robert mentioned again was my suspicion from the shift from capital financing to trade is probably because China might, following the last round of DSSI discussions, probably walked out of the discussion with a bit of a bloody nose, given the need to restructure its debt. And suddenly, I mean, if you talk to any Chinese relationships you have, we have one with Sinosure, we talk to them all the time, you get a sense that there are jurisdictions that they are suddenly labeled as no-go zones. There's jurisdictions that they've got capacity full, where traditionally they have been, but I guess it's walking out of the whole issue of debt restructuring without achieving their original goals.
Okay, thanks. I'd like to move on a little bit now to look at the opportunities that maybe there. Perhaps, Monale, if I can come to you first. Where do you see the opportunities at the moment, and do you see them mainly on the infrastructure side? Do you subscribe to the view that still a lot more infrastructure is required in order to benefit from the increased trade flows, but also ACFA when it's properly up and running? What would your view be on that?
Thanks so much. I think there is no doubt that, and it has been documented, there's a huge gap in Africa with regards to infrastructure. And given that infrastructure underpins trade, it's also then obviously true that the underperformance in the African continent is therefore in trade, that is constrained by the lack of or the poor infrastructure. What is fundamentally unsustainable is that when we talk about infrastructure financing in the continent of Africa, a country called China always comes up. It cannot be sustainable that there is such a dependence that infrastructure in the continent has to be driven by a particular country. So I think it really now exposes the extent of weaknesses in Africa doing things for itself. I think it goes to the ability of the continent to mobilize resources for its own infrastructure challenges. If you think of the value of what intra-trade can do in the continent, intra-Africa trade that is, when you compare the averages to what happens in other parts of the continent, and that alone tells you and points to the fact that there is a lot of economic activity that can happen within the continent itself. So what happens with that economic activity? It follows that investors understand these concepts very well. If there's economic growth in the continent, resources across the globe will follow the growth. It goes without saying. Then you have to then think about how then infrastructure programs are structured such that they can make sense to global investors. What are the traditional weaknesses in the continent with regards to policy and regulation that puts off global investors, that you can attract capital market investment coming through to finance infrastructure? And I think that's what we need to be looking at. And that's the role that institutions like ourselves, MDBs, partnering with commercial banks, partnering with other DFIs, have to play. We are certainly seeing, and apart from the geopolitical risks that are, and just put a stop on those, right? And just think of what are the potentials, as your question was more pointing towards. That as a new institution, we're seeing a lot of interest from different countries in the continent who are becoming members. As an example, Egypt has just joined the bank, the NDB. What has been happening in Egypt was a strategic intent by Egypt to partner with various MDBs. Much of Egypt's infrastructure is done by Islamic Development Bank. The Asian Infrastructure Bank is very active. So there's various number of DFIs that are driving the story of Egypt at the moment with regards to infrastructure. So that can be adopted by any other country. In South Africa, it's certainly the case. The traditional called Bretton Woods institutions have been attached a stigma in the continent, right? Perhaps maybe from the structural adjustment programs of the 1980s and so forth. But the environment has changed. The proposition is very, very different. South Africa is a member in the World Bank, it's a member in the AFDB, is a member, but if you listen to the politics, you get that the country is discouraged from borrowing from those institutions. Other countries in the globe, they would go fully for the allocations that these institutions provide as resources every year. Where does the money go into? The money goes into infrastructure, very, very cheap resources. And the money comes also with hand-holding. It comes with fiducial oversight from this, because there's a lot of project monitoring and supervision that comes with this. So all of that is a package that helps to improve throughput of the infrastructure build. So it really talks to just a change in culture in the way that we do things in the continent. But I am just putting my hope in the fact that I think the starting point, which is if we improve trade in the continent, we improve the policy and regulatory environment, and we package projects differently, such that maybe there's less risk on the government. The government becomes an enabler, perhaps providing purchase agreements rather than being a party to the loans, and leave the private sector to package triple Ps to come in, do project finance, and that you can almost say borrow from the South African story with renewable programs that are happening. Over close to $250 billion in the last 10 years or so in renewables in South Africa is done off the balance sheet of the state. And just by design and by the state playing a role in just enabling facilitation, of course, in terms of credit enhancement of the program. So I think there is a lot of potential in the continent. I think it requires a mind shift. It requires that countries must not look at a loan and think, by the first immediate sign of pressure with the fiscus, then not paying the loan is the first option, because then that creates this precedent and creates this culture and creates some sort of a perception with investors that Africa is not investable. But we're seeing a changing trend, especially as a new institution. Most definitely, the conversations we are having, I think there's a lot of scope and that we are looking to play, and I think we can play.
Yeah, thank you. I was just going to open to the floor for any questions as we're about 2/3 of the way through. Does anybody have any questions at this point? No? Okay, we'll move on. You've got about another 10 minutes to come up with some interesting questions for the end. What I'd like to look at now are the potential for different investment coming into Africa, mainly through non-traditional investors and non-traditional financiers. So Rob, perhaps if I can come to you first, where do you see the likely new or increasing investment coming in from the less traditional sources?
Thanks, Simon. At the beginning of this year, as a company, we gathered together virtually gathered together with my analysts, and we looked at the key themes for 2022. And one of them was very strongly the idea that African countries are indeed benefiting from different origins of investment, no longer just to focus on Europe or the US or even China, but that there are other, let's call them non-traditional powers or partners which are emerging. And one of them is Russia. As I mentioned earlier, Russia has about a $20 billion trade relationship. Much of that is focused on security and military relationships with a number of African governments. Some of it's focused on mining, like bauxite through its company Rusal, or diamonds through its company Alrosa. But most is actually focused on the security military side for Russia. It's almost punching above its weight in terms of trade and investment just by focusing almost exclusively on military and security cooperation. But more interestingly than Russia is Turkey. Turkey has, over the past few years, staked out a huge hegemony almost, so to speak, in Central, East and West Africa, where the Turkish president has been visiting more African countries than anyone else during the pandemic. There are so many new Turkish embassies opening up. Many African governments are signing military supply agreements with Turkey. At one of the panels yesterday, we were talking about how substantial military exports are out of total of export finance. And Turkey is providing a big chunk of that. For example, some of the Turkish Bayraktar drones are being sold to a number of African governments, but also small weaponry. And not just focused on the military and defense sector, but also IT, communications, banking is all being opened up through the growing Turkish relationship. And I think the UAE is interesting to mention as well, because the UAE has positioned itself almost as an African trading hub, an African banking hub. Many of the companies who are here, many of the banks who are here, have their Africa offices in Dubai, almost as a virtual African city. And again, your military exports, your manufacturing exports, and of course, very much trade, transport and logistics all goes through the UAE. Many of us will be flying to or out of Africa through the UAE or through Turkey. So I think that's just three. There's Russia, Turkey, the UAE are really interesting ones to watch. And I think it's a real interplay between the Middle East and Africa that we are seeing increasingly. And we've talked about it at previous GTR conference as well. And we're really seeing this at the moment, particularly now with the space that is being created with the sanctions on Russia for these non-traditional powers, and indeed the traditional powers, to step in and fill some of that void. Thanks, Simon.
And I mean, in terms of the sectors you're looking at, I mean, traditionally, if you were looking at the Middle East, for example, you would be looking at oil and gas, something like that. For each of these non-traditional investors, do you see specific sectors being more relevant than others? Looking at it from the Africa side, because obviously they need to attract the investment. So what should they be looking at where, I suppose, is the question. So make sure they're focusing in the right areas, in the right geographies.
You mentioned oil and gas, and that's what's one area where non-traditional investors will not play a big role. Oil and gas will still be financed by Western export credit agencies, banks, governments, particularly because of the diversification of supply that is necessary, and also because natural gas is still considered by the European Union and others as a green source of energy. So that's one area where the traditional partners will remain their dominance. But outside of that, I think military and security I've mentioned a couple of times. Turkey will want to step in on Russia's market share there. And then mining is a very interesting one, particularly for some of these ramping up of big metals projects. We've mentioned during the course of this conference gold, platinum, palladium, neon, aluminium or bauxite. These are Russian-dominated metals, and this is a real opportunity for Turkish companies, Chinese companies, Western companies to step in. And beyond that, I think it's very much focused on the digitization drive and supply chain finance as well, Simon. We've particularly seen some real interest from Middle Eastern companies stepping in here as well. So there's a lot to talk about, but I think just those three are interesting ones to point out at this stage.
Sure, I mean, it's virtually a session on its own, that topic. Jim, I think you wanted to jump in.
Thank you. As a politician, I'm used to shouting at stages, so I'll use the microphone. It's more polite, isn't it? But I think to agree, the point about Turkey, when we are working in Central and West Africa, the people that we bump into most regularly and counterintuitively would be Turkish diplomats who are seeking to build relationships with senior government interlocutors in a multitude of countries. And as we've just heard, Robert talked about drones, and it's not for no reason that Turkey is supplying Ukraine with the drones. It's not for no reason that Turkish drones were so important in the Armenian-Azerbaijani conflict last year. I've lost my track of COVID, concertinas, your memory horizons, but I think in terms of last year, so Turkey is on an onslaught in that regard. The other place to look, I think, which might sound surprising, is Germany under its new leadership. Olaf Scholz is taking a different posture on geopolitics, and I think it might also see a different approach post-Merkel on global investment relationships. And certainly Germany is increasingly interested in being active here in South Africa. I wouldn't rule out the fact that there are huge pools of capital in Paris, New York and London looking for a home. And when we're advising these, acting as advisors to these corporates, look, it's in every sector, but at the moment, this is pre-Russia, pre-Russia's invasion, it would have been water, energy, digital infrastructure. And then, for reasons that I haven't fully worked out, but I'm glad they have done, is in London professional services firms, a big drive on building anti-corruption capacity. in Sub-Saharan Africa, and certainly we're very active there over the last year or so. I'd like to have time to figure out where this has come from, but when prospective clients knock on your door and say, we'd like you to work with us on anti-corruption measures, I'd like to get to the point as to what's driving that, but nevertheless it exists, and that's an increased sector that I think we'll see more play in out of London in particular.
And a plus. Sekete, just in terms of the different models of financing that you're seeing, there's obviously there's always this mix of the extent to which local banks are involved, at what level are they involved, is it in collaboration with the international finance market, or is it something which is kept at a lower level, and to what extent funds are funneled down to them from the international financing? What are you seeing as the different types of structures and collaboration between the various types of financial institutions, including the non-bank funds?
Thanks, Sama. Maybe the answer to it lies into what sources of funding, particularly as we consider infrastructure, continue to be available for Africa in particular. We spoke earlier about the fact that we've seen China's involvement receding as far as its contribution to Africa's financing of infrastructure. On the one hand, we've seen, since 1995, Simon, we've seen an emergence of most sovereigns in Africa availing themselves to capital markets, with the Eurobond playing a significant role on most of those sovereigns, which is quite impressive. And of course, the domestic financing will always be key. You only need to go look at the component of most of Africa's debt, that there's still a good, despite low capital markets, there's still a significant domestic financing into it. So there's abundance of liquidity. There continues to be players emerging. I mean, you just have to be part of a syndication team to understand, and I'm not in syndications, by the way, but to understand or see the emergence of funds that suddenly avail themselves. I'm sure they want to find home to long-term capital from insurance and pensions point of view. But the key thing that I would love to discuss briefly, which could be a topic to continue unpacking, it's enabling the sources of liquidity to really make a meaningful impact. And let me pick up an example. Insurance, for example, in terms of risk mitigation, including ECA and multilateral development financing, in terms of it enabling risk mitigation of commercial financing. Unfortunately, and if we pick up on insurance in particular, unfortunately, the market, the industry hasn't quite adopted it as a product where agreement through interpreting the regulations could have been made. So we're not getting the full benefit of recognizing the benefits of using these risk mitigation tools. Another example could be most of us as banks, we have good rating tools that rates corporates. We don't have rating tools that rates insurers, but yet we rely on insurers to risk mitigate our loans. And as a result, we don't get the benefit of the two rating that is sitting with those insurers in order to be able to give the borrowers better financing. I would continue to add the sentiment expressed in a paper published by ITFA. Some of you may have seen it, of the 21st of February, talking about how there's this uneven consensus in terms of the LGDs that are used where insurance comes in to risk mitigate the loans. Foundation Basel III standards talks of 45. Do you really get to that level of losses in any scenario? The question is no. And of course, that position paper argues from 10 to 20. My last point would be again back to regulations. We use export credit finance to cover our loans. We proceed on data substitution mechanisms. The regulations are not clear. They're leaving a lot for interpretation. Some institutions will pull both risk metrics of LGD and PD. Some would do LGD because it favors them. Some will do PD because it favors them. There's an uneven playing field out there. And I would argue that it's to the detriment of the borrowers. I would argue that in Africa's case, it is to the detriment of the sovereigns in Africa who are borrowing to try and put up their infrastructure. As a result, that I think the industry needs to get together to push the regulators to have a uniform way of looking at this if we're going to help the continent to employ this many and varied liquidity angles.
Okay, thank you. Well, we're just coming towards the end of the session, and we actually have a first question. And the question is, food security in Africa already treads a fine line, as does the wider cost of living conversation. Does the panel think African countries will mirror the West in terms of their concerns over this? Would anyone like to take that one?
I think all of us would say yes. And the question in European capitals is to what extent are populations willing to bear some of the burden of the likely consequences in terms of higher domestic heating bills, higher inflation. For example, UK inflation was already projected to be at 7% by the end of this year, which I think is more than double South Africa's inflation rate, I think. So that'll increase further. So of course, food security, food affordability, energy affordability, and just the plethora of additional consequences that are going to flow out of Ukraine and Russia's conflict. But I think what we'll find, which will cause additional pressures for our African governments, is that China will be first in line to exploit a weakened Russia. China in Eastern Siberia, on energy security, on food prices, food availability, exports and much else. China will be brilliant at exploiting Putin's weakness. So it's a strategic opportunity for them.
Okay. Rob, did you have
Just quickly on the back of Jim's point, higher fuel prices will push up the cost of transport for food. Then you have a lack of fertilizers, particularly urea and phosphate, that will push up food prices, and the shortage of wheat and corn. That said, many countries have, even though they might be reliant on imports from from Russia and Ukraine, they do have stockpiles. And already a number of countries are going to tenders and trying to buy very expensive French and US grain and wheat on those tender markets to try and avoid this food insecurity situation. So we have a bit of time, but the countries I'm really worried about in the short term, Egypt, Sudan, and potentially Kenya, those three are very, very reliant on wheat and grain that has not yet arrived in their countries, not yet in stockpile. So if we see those countries not being able to go to tender in the next few weeks or months, they could see the initial food security crisis hitting that part of the Horn of Africa first.